What is up, everybody? Welcome back to the Most Valuable Podcast. I am Mark Williams with my colleague
Victor Castro.
And we're just two dudes who do real estate for a living. Thank you for joining us once again. If you're listening live right when it drops, so it's Thursday around 9 a.m. Thank you guys for subscribing, liking, sharing our podcast on all platforms and on YouTube if you want to watch the video and just watch us talk on a mic. But today we were trying to think of a topic, man. We're going on episode 22, I think this is. I'm pretty sure it's episode 22. And, you know, we've been covering a lot of stuff. You know, sometimes it's hard to figure out what we're going to be talking about. And so we asked our videographer, Alex, with Shadow Films. Make sure you follow him on IG at Shadow Films. And if you're in our office, when you walk by our office, you'll see his desk has this like poster in front of it with this QR code. It's a great idea. It's free advertising, and like people could walk around and scan his QR code and maybe book him for jobs.
Maybe.
I wonder who thought about that idea. It's a great idea. You're welcome, Alex. But yeah, make sure to follow him. But we asked him. I said, "Hey, man, like, what should we talk about?" And he's like, "Why don't you talk about requirements to like qualify for a home?" And in his regards, self-employed. He's self-employed. He made the jump a couple years back, hasn't looked back, right? So same with us. We're self-employed. So let's talk about requirements on this episode, Victor. We'll touch base on self-employed. We'll touch base on employed, hourly, salary, ITIN, stated income, maybe. You know, we're not mortgage lenders, but we do enough business. We definitely understand how mortgages work. I have a background in finance before getting into real estate for many years, so I definitely understand it. And we work hand in hand with our trusted lender, Cindy Castro with Supreme Lending and her team. So any questions that you have, if you DM us, we can get you that answer as well. So let's jump into it, Victor. Why don't you cover it? Let's cover one. Let's cover your typical 9 to 5 worker.
9 to 5.
Hourly, you get paid every 2 weeks.
Yes. So look, what's up, everyone? So as far as requirements, they're pretty much the same regardless of what type of employment you have. Yes, you're going to have different types of programs that you might be able to qualify. That's a different story. The requirements are, for the most part, the same. You're going to have to prove what your income is, and they're going to ask for your 2 last year's tax returns with either your W-2s or 1099s. They're going to ask for your credit history, so they're going to have to run your credit to make sure that your credit is in good standing and you don't have too much debt, which is the third requirement. They want to make sure that that debt is not going to impact the amount that you can pay per month, essentially. So what you make, how much do you actually retain after the debt? And lastly is your down payment.
Yep.
Okay, your down payment for your down payment and your closing costs. How much money do you actually need depending on the program that you're going to be, tried to be approved for?
Yeah, and I think people get caught up too much in the down payment.
Yeah.
Right. I was talking to someone the other day, and they're actually a homeowner, and they want to upgrade their home. But obviously they bought their home a couple of years back, and the new homes are more expensive, and they're like, man, where am I going to come up with this 20%? And the first thing I asked them was like, why? Like, why you need 20%? Yes, if you got it, great. But there's like this ingrained thought process, and it's crazy how many times we go on a podcast or we talk on an Instagram reel or something like that, and we just say, you don't need 20%. These programs can be anywhere from 3, 3.5, 5, 10, 15, 20. If you're a VA, 0, right? So down payment, yes, but then again, we'll calculate that because sometimes it may make sense to keep more of the cash in your account because it only changes your payment like an insignificant amount, right? You can put 10% down or 20% down, but if 10% down only changes your payment to like $200 more a month, you may want to keep that extra 60, 70, 80 grand in your bank as reserves.
Emergency wise,
maybe you
invest it right back into the property.
Do some renovations, So So that's a qualification though. And then yeah, like your income. 9 to 5 is pretty easy to calculate, right? Look at your paycheck. If you work 40 hours a week, what do you normally get paid?
That's actually another thing that they'll require from you is your last pay stubs in the last
You
30 days
gotta
that you received.
prove what you make,
Yeah.
right? So there's a difference. Let's talk about the what it takes is something. First and foremost, you got to fill out an application, right? And here's the difference. There's something called a pre-approval and a pre-qualification. Now, anyone that's been on YouTube or TV, you've seen these ads by Rocket Mortgage, okay? There's other companies. I'm not just them. They're the biggest one. You can go on their website right now and type in numbers, and they're going to give you a pre-qualification. And then they're going to say, yeah, you can go to your agent and use that get a pre-qualification in minutes. That means absolutely nothing because nothing has been proven. Pre-approval. Say it together. Approval. Right? So you got to like get approved. That means nothing. The best way to do it is to reach out to a lender. And if you need one, we got one. And they'll give you the link. They'll fill out the application. And then they're going to collect documents. If you're a 9 to 5 worker, 2 most recent pay stubs. Boom. Check. Okay. Proof of funds. Where's that money coming from? We need to see the bank account. 2 months. Right? Okay. Boom. They're going to pull your credit. 1, they got to see your score. And 2, they're going to see what actual debt you have and what the monthly payments are. Then they're going to get that information that they already gathered, and they're going to give you a pre-approval. The one we use, the lender we use, goes one step further that is required on lending, and it's something called a verification of employment. Now, they're going to actually contact your HR department, and they're going to get a form filled out that says how long you've been there, what you get paid hourly, if overtime is something that is given a lot, like how consistent do you get it, and if you're actually still employed with that company, right? And that actually gets done twice. It gets done to approve you, and then they recheck your employment 5 days before the closing of the home.
And there's a reason for that.
Yeah.
The reason is, what if you went and bought yourself a car in the middle of this process and didn't tell anyone about it? They got to check it. That's why that's why they got to re-verify that your debt hasn't changed, your credit is still the same, and your employment is still the same. You're still making the same amount.
Yeah. So let's go to, so that's like your 9 to 5, okay? If you're a salary, if you get paid salary, say I don't make overtime, I just get paid, every 2 weeks I get the same. It's going to be very similar. It's almost the same thing. They're going to see, it's actually a little bit easier to prove if you're salary because you got an offer letter that says you make X amount of money a year, and that doesn't change regardless if you work 20 hours a week or you work 60 hours a week, right? Your salary is your salary. Now, where it gets tricky is a lot of salary employees get bonuses, okay? In order to use your bonus, you have to get that bonus for 2 consecutive years, and then they use the average of that, all right? Here's another thing. If in writing on that verification of employment, your employer is willing to say that you are getting this bonus is guaranteed, then you don't need 2 years. You can just do 1 year, but it needs to be guaranteed that this is something that you get, right? It can't just be a hypothetical like, well, last year I got a bonus of $50K, so I might get one this year. If you didn't get one this year, they can't use it. And if it's only been 1 year, they won't use that $50K. Yeah, you have to guarantee that you get that money, if that makes sense to everybody. So we got hourly, we got salary, about the same. How about commission-based?
Yeah, so commission is a little tricky because
it's not guaranteed.
It's not guaranteed. So they're going to average what you made, more or less for that year. And that's the amount of money that you're going to be able to use.
And they usually go 2 years for your average, right?
But the last year being the most important one.
Yes. Sometimes I've seen them where they gone 3 if they want to be real. And the underwriting, there's no gray area in lending. Let's like full disclosure. If you're working with the lender and it sounds kind of fishy what they're trying to do. It probably is fishy.
Yeah.
There's no, especially since the crash, right? The economic downturn in 2008, 9, 10, 11, 12, like rules that weren't in place then are now in place. Lending is very black and white on traditional lending. Okay. When someone says traditional lending, they're talking about lending products that are regulated by the government, basically. There's rules and regulations that are in place to make sure that fair lending practices are taking place. Okay, now the government doesn't own these companies, but they do regulate this industry. And they do that to prevent what happened before, people getting taken advantage of and gray areas. It's very black and white is lending. Easy way to put it. There's a yes and a no. There's really no maybe. And if it is a maybe, it's a maybe because we don't have that documentation to make it a yes. And if you can get that yes, then that maybe turns into a solid yes. And what I mean by that is like a bonus. You may be able to use this year's bonus if you can prove that you're going to get it.
Right.
Right? That's the maybe that can turn yes. Not, oh, yeah, we'll just say you got it. It doesn't work that way.
Right.
Not anymore. So we got hourly, salary, commission. What if you get paid like under the table, Victor? Is there an option for you?
Yes, there is. It's called a bank statement loan. And what the lender will ask is that you provide 12 months of bank statements to show proof that you've been depositing enough money into your bank account. And they'll average it out. And that's what you're...
And they just look at the deposit.
Yeah, they look at the deposit, but also it's a little bit more expensive, unfortunately.
Because
it's more risk for the bank.
Yeah, and it's not a traditional loan, right? It's what do they call them again? Man, I just went blank. Was it QR loans or? It's a non-traditional, whatever the word is. Like I said, we're not lenders, right? I know the word. It's just slipping my mind. But basically, it's more of like an investor is lending you the money, like a private investor. Or this company does like high risk loans, right? So, like you said, it's going to be a little bit more cost associated with it. The interest rates are going to usually be a little bit higher. There's more risk to it. Bank statement, 12 months of your bank statements, they're going to look at all deposits, and they're going to average out like what you make. They're still going to pull your credit. There's still credit requirements, right? There's still debt requirements, right? So, and usually those require larger down payments to kind of absorb some of that risk.
Yes.
So we have hourly, we have salary, we have commission. Hey, under the table, you should be filing your taxes though.
Right.
But hey, we leave that to you.
Business owners.
Self-employed. Like at Shadow Films on Instagram. Hire him for all your photo and videographer needs. Okay. And so self-employed. What's that look like, Victor?
Yeah. So very tricky. I kid you not. I've seen a lot of people mess up their qualification because they don't report enough on what they make. They actually make really good money, but if you're not reporting it on paper, then there's only so much they can do for you. In other words, let's just give you an example. Let's say you make $200,000 a year. You know, your business does really well.
Yeah.
You're self-employed. Maybe, I don't know, you have a landscape company or something like that. And you write everything off. You deduct everything that you can so that you don't pay any taxes. Of course, who wants to pay taxes, right? But
look, we're not telling you. I don't know, man. IRS might be listening, bro. Look, we're not telling you to do tax evasion or whatever they call it.
Right.
Maybe you do have a lot of write-offs, right? Maybe you're writing a little bit too much off. Maybe you need to reassess your business and actually have some income, right? Victor's laughing. If you're watching on YouTube, you're seeing him laugh, but you know what? That's what we're saying. We're saying like you have a lot of write-offs,
right?
And they're probably good write-offs, but and I'll get into this once you're done with your thought. But maybe you're writing off a little bit too much.
Yes, that is going to hurt your chances of qualifying for the amount that you want to qualify. If you want to buy, a $800,000 home, but you're only reporting
You make 20 grand.
20 grand, 30 grand, then it's going to be very difficult to get you qualified for that amount.
And they go so there's a point that this is where like my financial background came in handy when I started in real estate, because as a real estate agent, I am self-employed. You as well, Victor. And understanding that going from a salary-based job to a self-employed, there's a transition period. I go from getting a W-2 and getting set amount of income a year to now my income, who knows, right? And then here's the thing. When you make that transition, so if you're listening to this and you're like, hey, I do landscaping. I've been getting paid under the table. I want to make my business legit because I want to be able to purchase properties and expand my business and stuff like that, right? You get your business license. You become an LLC. That first year, you're going to file taxes. Now that's your first year as a business, right? So you got to be, and if you know buying a home is in your future, you need to talk to a CPA, because that year you may not want to have as many write-offs as possible, because in order to purchase that home, you're going to need to show, usually it's 2 years of business taxes, and they're going to average that amount out. So if year one, you only make $20K, but then in year two, you make $200K, well, they're going to take 220 divided by 2, and they're going to say you only make 110. If that quick equation made sense, where it may make sense to pay a little bit, to have a little bit less write-offs and a little bit more tax exposure in that first couple years if buying a home is in your near future. Now, that's where being a business owner can also be beneficial, is if you're already a homeowner and you're not looking to purchase or refi anytime soon, then you can make sure that your business is spending more of its profits before it gets taxed, right?
Right.
You have flexibility.
There's a way to structure it where it's going to make sense for you.
Yeah.
But you have to get informed before deciding to, hurt your chances of becoming a homeowner.
Because sometimes it may make sense to, get into that home first before you make that leap into, maybe you have a side business that's really maybe you do catering, right? We just had some catering done for a party. Maybe that person has a 9 to 5, and on the side they're doing catering. Their catering business is ramping up, and they get their business license and they're ready to go. And they're like, cool, we want to get a home with a big enough kitchen. It may make sense to get that home now while you still have your 9 to 5 and your income's easier to prove. And then once you get the home, once you sign on the dotted line and that lender gives you that money, like, as long as that mortgage gets paid, you're good, right? Maybe then it's your opportunity to make that leap.
Transition into
that self-employment, bro.
Yeah, great. That's a great advice, bro. Like, I always tell them, like, you have to get informed before you decide to do anything, because we've seen so many people, hurt the chances of them buying a home, or they just can't.
What's someone's biggest fear? I got one, and I'll see if you have the same one that pops in your mind. When you talk to potential home buyer, Victor, and you listening, this is probably whatever he says and whatever I say, it's probably going to be what's on your mind too. And you're like, everything sounds good, and they're asking you all these questions, and then you tell them, okay, the next step is to apply. What's their biggest pushback usually?
Well, I mean, there could be a few, but
what's one that like stands out to you?
I don't want to run my credit.
That's the one I was thinking of. I don't want to run my credit. I want everybody that's listening right now, if you're driving, do this after you're driving, or I'll tell you what it is. If you Google what the effect is on a credit pool, it's 5 points or less.
This isn't buying a car, guys. This is different.
And even when you buy like a car, when you run, and here's the thing with mortgage, if you run an application, I want to say it's within 14 days. It could be longer.
14 days.
If you shop around different lenders, the FICO is going to know that you're shopping around for the best rate. It only ding. It will readjust and only ding you once within those 14 days. But it's 5 points or less. On average, it's like 2 points. Look, if you're at an 800 and it drops you to a 798, it's not going to make much of a difference. Here's the thing, though. Once the loan closes, the 2 points are going to go back up, right? I think it's worth sacrificing 2 points to figure out what it's going to take for you to qualify for a loan.
Yeah. No, I mean, you see people bring up their credit scores easily within a matter of months. You can get their credit up super quick. Actually, our lender does something called a rapid rescore.
Yeah, you can do a rapid rescore,
which is essentially going to you might know a little bit more than that.
Essentially,
Explain
what it is it's a cost, and they reevaluate. So let's just say they pulled your credit.
Yeah.
And your credit's at 650. And at 660, you qualify for this program. So you need to bring your score up 10 points. And they advise you, the lender advised you, they said, hey, you have this Best Buy card that's charging you $300 a month. Let's pay that one off because your balance is only $2,000 from that laptop that you didn't need, but you bought anyways. Because you can put it at, 0% financing that you didn't pay off in time. Now you're at 25% interest, but you weren't crying about running your credit then and worrying about the 2 points.
Right.
I'm going off on a tangent right there. But come on, man. I worked at a bank for 13 plus years.
Yeah.
I seen this. This is what happens, right?
Yeah.
It's like you're scared to run your credit for a mortgage because it's going to ding you 5 points, but you have a Best Buy card, a K Jewelers card, a Nordstrom's card, a Macy's card at like 30% interest rate.
And then you know what makes me even more mad is when people co-sign for other people.
Oh my gosh.
It's like, are you serious?
That could be a whole nother podcast.
Yeah, that'll be we'll talk about credit on another day.
Do not cosign.
No, bro, my God. You want to help the tío.
Yeah.
They want to buy that nice truck and they need your credit. They don't have any credit.
But the rapid rescore. So essentially you make some changes to your credit profile and then they pay to have them rescore you.
Right.
And then your credit, that way they can get the credit to the number that is needed to qualify you for more money, a better rate, or some type of assistance program. So that's the rapid rescore.
Yeah.
But yeah, that's the one. The biggest fear is everyone's like, I don't want to run my credit.
Yeah.
That's how they say it too. I don't want to run my credit.
Yeah. Or when you ask them, how would you feel? Do you feel comfortable doing this? And they never give an answer. They just ghost you.
Yeah. Look, there's no judgment in our profession.
At all.
I don't care if you have a perfect credit score or the world's worst credit score. We're just here to help you.
How much debt you have, it doesn't matter.
It doesn't matter. Like, we want to see you win. And if we're not the ones you win with eventually because it's going to take a while and you end up going a different route. But if we were the ones that help plant that seed, then I'm all for it. If I can steer you in the right direction, hopefully you get to that point where our paths cross again and I can help you complete that goal of home ownership. But if that home ownership never even becomes a reality, but maybe it helps you get in a better financial situation, then hey, that's what we're here for.
Yep.
That's what we're here for. And, qualifying. So, I think it's like I said, it's pretty cut and dry, like what you can qualify for. But there's only one way to find out.
Yeah. You have to go through the process.
Everyone likes to window shop, and that's what those apps like Redfin and Zillow and stuff are great for. But if you're really serious about buying, you have to qualify. It's better to know what you qualify for than to just find. Well, I always tell people, what if you know you want to become a homeowner, whether it's 3 months from now or 12 months from now, but you're window shopping. If it's in your head, you're thinking about it.
Yeah.
And you see that perfect home and you go to the open house without an agent, right? And you go and you're like, damn, I like it. And then you're like, dude, I listened to this podcast called Most Valuable Podcast. I like those guys. Hey, Mark Victor, I saw my dream home. And we're like, cool. Let's go check it out. Hey, offers are due next Tuesday. We got some time. Are you pre-approved? Nope. Let's get you in front of Cindy Castro with Supreme Lending. And The home is $800K and you run the qualifications and boom, you're qualified for $620.
It's happened before.
There goes that dream.
It's happened before multiple times,
Yeah.
Mark. And it's funny that you mentioned that because we do the Home of the Week, Instagram, TikTok.
Yeah, home of the week.
Make sure you check that out.
Wednesdays.
Every Wednesday, we have a Home of the Week. Well, I had someone reach out to me. They're like, wow, this home is beautiful. I want to buy it. I'm like, are you pre-approved? No, I'm not. I'm like, well, we got to see if you're approved to buy this home first before we can do anything for you. And they didn't want to move forward. So it's like you have to want it more than us want it for you. You got to want it more for yourself than us.
And not be scared. Look, if you go through the approval, that those clients that I helped in December, they worked with another agent before me, and they were house shopping the year before, and they were only approved for a lesser amount because the application was ran just under one income, right? And so they kind of had an idea of the process. And what I get at is they weren't scared. So they made that initial jump, and they knew that to get in a home they wanted, they needed to get more income. So when they reached out to me, we found the strategy to make it work for them, to get them as much approval power as possible. And they got into a great home. And we're looking in different neighborhoods than what they were looking in when they were working with the other agent. So the thing is, just because you get approved doesn't mean we're going to go out and sell your home the next day. I think that's another big fear if you're listening to this. We're not car salesmen. We're not running your credit and trying to get you into a car that day, right? Because we got a quota to meet that month. No. We're here to educate and inform you. And if you're thinking about buying a home and you want to just know what you're approved for now, fill out the application. Take a little 5-point
Guys,
thing.
it doesn't cost a dime.
It's free.
It's free information.
See where you stand. And I say, hey, see where you stand. That way, when you're window shopping, you know where you stand. And here's the thing. As long as your income and situation doesn't really change over a course of 6 months to a year, and interest rates don't take some crazy turn against you, right? If they go down, you're going to be approved for even more. So it's a win. But you'll know, like, when you're window shopping, you know what you can afford. Instead of, like, hoping, you'll know.
And it's okay if you don't qualify. At least you're going to know what you have to do to qualify for more.
Yeah.
Whether it's make more money, get a second job, bring someone else into the equation. Maybe you bring in a, I don't know, family member or whatever.
And that's not bad.
That's not bad.
Bro, there was just a report on, like, mainstream news that
more and more people are
buying together.
Yep.
Families are coming together, especially here in the Bay Area and California in general, but in high real estate areas, more and more families are coming together to qualify to buy a home. So you're not the only one doing it.
Yep.
Right? Like, sometimes that's what it takes to get it done.
Instead of getting together to buy a vehicle, a car, go buy yourself a house.
Yeah. Yeah. Buy the house before you park the new car in there. But, so that's basically qualifications, right? They're going to check your income, right? Income, credit, your debt, how much you actually bring in. And for most pays, most like salary, 9 to 5 jobs, it's your gross income. So what you make before your deductions.
Correct.
Okay. And then when it's your self-employed business, it's your net. So that's the big difference.
Yeah.
That's the main difference. If you're a W-2 employee, it's gross income. If you're self-employed, it's net income after all your deductions. Okay. That's like, if you take anything away from this, gross income, W-2 employee, net income, self-employed. That's kind of how it goes.
That's how it is. That's how the cookie crumbles.
Anything else you want to add?
No, we hope you enjoyed listening to this podcast. That now you're a little bit more informed. Maybe this is all you needed to grow the courage and reach out to us.
Yeah. Hey, shameless plug. If you want to know about the home buying process before you fill out the application, we have the MVP Real Estate Masterclass that's given 3 times a week. That is free.
Yes,
and
sir.
it's less than 25 minutes of your day, right? You can go on our website, www.themvprealestate.com. You can go on our IG at the MVP Real Estate, and there's links to sign up for it. Find out what the process is about, and then after that, we can get you set up to run an application and see where you stand.
Yeah. So it's what's funny. We actually pretty much gave the master class during this, in a way.
A portion of it.
A portion of it.
I mean, we'll go in more detail.
Right.
But yeah.
Yeah.
Hey,
So-
that's what we're here. Knowledge is power. And with that, we look
Look forward
forward
to winning with you.